Greetings. We're on our way into part 2 of our module 3 set of videos. We're going to be talking about adjusting entries, also known as AJEs or adjusting journal entries. Why do we need to make adjustments at the end of the month, the end of the quarter, end of the year? Well, we're going to talk more about the hows and the whys that go with that. So let me go ahead and share my screen, give you an idea. As I said, we're talking adjusting journal entries. One of the steps, we start at that unadjusted trial balance, and we make these adjustments that yield an adjusted trial balance as we go forward. So what is this all accounting adjustments about? So why are we doing this? Well, we might have earned wages that we haven't paid yet, haven't written the checks. We have a payday on January 5th, but we want to get wages and expenses into the proper year last year through 12/31. So we need to make an adjusting journal entry to take care of that, to make that adjustment. We might have things that we owe, and this is in case that was a wages payable that was coming out of that. There may be unearned revenues or prepaid expenses that get used up or get earned. Other way around, actually. Unearned revenues get earned. The plane tickets, the plane takes off and lands. We need to make some adjustments. The prepaid expenses that we had, the things that we paid in advance that we actually used, maybe an insurance policy, we used up a month or 3 months or a year's worth, depending on how big a business. Let's take a quick look at the accounting periods that go with this. When do we make adjustments? Well, the major companies are probably going to be doing it monthly. You might do a monthly adjustment for depreciation expense. You might have monthly adjustments for those wages. Or you might have quarterly. There's 3 months in a quarter. You might have annual. Small companies especially might just make an annual adjustment. I don't worry about depreciation until the end of the year. I don't care as we go, and just so I can get my taxes together and do things right. Sometimes semi-annually. Accounting periods are kind of interesting. Now, not all businesses have 12 complete months of accounting periods. A restaurant will typically have 13 monthly periods. You say 13, why does that work? Well, you figure a pizzeria, you got 4 weeks of Fridays, 4 weeks of Saturdays, those are your busiest days. If you shoot a month that happened to have 5 Fridays or 5 Saturdays, and you're comparing months, throw things off. How about February, which is 28 days typically, and other months that are 31 days? That's a 3-day difference. So what's 3 out of 30 days? That's roughly 1/10. That's a 10% difference just because of the number of days. So sometimes these things match up nicely, sometimes they don't, but just be aware of what accounting periods and fiscal periods are all about. Let's talk about the types of adjustments. There's the ones we've already recorded. We had prepaid expenses. We prepaid our rent. We prepaid our insurance. We have unearned revenues. Somebody gave us a check, gave us monies for a concert ticket, a plane ticket, or other services that we have not executed yet, that we can't put into revenues, so we have it on liabilities. And then we have the word accrual. Accrual, you want to think about, the best way to describe accrual is accrual equals estimate. You're estimating. Now, you can have a pretty good estimate. I might have a 90-day note at 1% a month, 12% annual interest. So that'd be 3%, 1% a month. I take out a note December 1st. On December 31, I owe 1 month's worth of interest. I'm estimating. I'm not going to get a bill for that interest. I don't get a bill for my mortgage usually. I don't get a bill. I know what to pay, and I go ahead and pay that on my notes. And a 90-day note, you're going to pay at maturity in 90 days, the note face value plus the interest at the same time. But you're going to have December's worth of interest going in the prior year, and you have January and February interest going into the next year. So in December 31, if we're a fiscal year, 12/31 year end, we need to accrue that interest expense. We estimate what it's about. We might have other bills that we know are coming, but we just have to make an estimate. We just did a trade show. We spent $120,000, we think, or thereabouts, but we don't have the slips yet. We don't have the employee reimbursement request yet. We don't have the credit card receipts yet. Better to put $120,000 in expenses on the books, and maybe it's 130, maybe it's 110, than to put 0 on the books and get hit with 120 down the road. So prepaid expenses, advanced cash payments that will ultimately become expenses. Unearned revenues, cash received from customers before we provide the goods or services. Accrued expenses, estimate of expenses incurred and recognized on the income statement, though it hasn't been paid yet. There's our wages. We have wage expense. We have interest expense. We have accrued revenues earned and recognized on the income statement, even though we haven't sent out the bills yet. So we actually did the work. The law firm might have done a whole bunch of work and hasn't billed it yet. They're actually usually pretty good about billing in advance, but sometimes they bill after the fact. So if you did a whole bunch of work in December and you haven't billed it to the customer yet, that means it's not on the books yet. You haven't recorded it, and we need to make that adjustment and make the book, record the books accordingly. So let's take a look at some of these adjustments and how they work. There's 2 rules to live by. Never, ever, 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 never, ever cash. Well, what do you mean no cash? Is it an adjustment? At the end of the year, I paid a bill. I paid my utility bill. That's not an adjusting entry. That's an actual entry. I paid a bill. I have my payables and my cash both going down, or my utility expense going up and my cash going down. I just paid a bill. That is not an adjustment. That's actually a payment. If I go in and estimate that I owe $1,000 in utilities, I now have a estimate that I put on the books, and I have a utilities payable and a utilities expense that I record, even if I don't have the bill yet. Cash is never adjusted in an adjusting entry. I get the bank statement. They're charging me $30 in fees. Again, that's a transaction, not an adjustment. That's going to be booked to cash into bank fees, bank fee expense. But it's not going to be an adjusting journal entry on those columns that we saw in the trial balance. And you're always adjusting one balance sheet account and one income statement account. Them's the rules. That's the flow. That's the way it's going to work. So when we look at that, the big picture is we're making adjustments at the end of a period, never cash, one balance sheet account, one income statement account. So we're not adjusting a liability and an asset. We're not adjusting an asset and equity. We're adjusting an income statement account and a balance sheet account. And so we'll look at a couple of these as we go. Prepaid expenses, well, the definition says, yeah, we prepaid something. We got a non-cash asset, and then we actually record so we have a liability, cash goes out the door, prepaid advertising. So we haven't taken advantage of the advertising yet. That was the original transaction. That's not an adjusting journal entry, by the way. It has cash in it. We wrote the check. We have an asset called prepaid expense, prepaid advertising expense, not on the income statement, but on the balance sheet. But now when we go to make an adjustment at the end of the period, we're going to hit the prepaid advertising, an asset, and we're going to hit the advertising expense on the income statement. No cash, one balance sheet account, one income statement account. And here's our FSET model, vertically flowing down, taking a look at how that works. So again, what are we doing with unearned revenues? We've got a liability. We got a deposit from a customer, or we got tickets paid for. We have unearned revenue and we got the cash. That's the transaction, the cash transaction. We got the money. That's not an adjusting entry. We're going down and we delivered on that. We sold some stuff. So this is our quadruple entry accounting again from double entry. We've got our unearned revenues become earned revenues. They go to sales from the balance sheet over to the income statement. Then we have our cost associated, or cost of goods sold. So our inventory is adjusted and our cost of goods sold is adjusted. So now again, the cost of goods sold is at our cost, inventory is at our cost, sales and unearned revenue is at our selling price at retail. Then we go down and say, oh, accrued expenses. We incurred $100 in wage expense and we adjust it with one entry to the payable and one to the expense. Eventually, so on January 5th, when we write the payroll check, we're going to pay cash. It's going to come out of the payable. But the top entry is on December 31st, where we have $100 in a payable on the balance sheet as a liability and $100 as an expense. Notice our balance sheet stays in balance. Assets still equal liabilities plus equity every time. And then we have accrued revenues. So we have a receivable and sales. We sold stuff on credit, okay? And we have that accrual associated when we generate the sale, even though we haven't recorded it yet, we need to adjust and say, oh yeah, we sold a bunch of stuff. We're going to put the sales on the books and the receivable on the books at the time that we make the adjusting journal entry. And we're going to do the quadruple entry accounting, adjust our inventory and cost of goods sold at the same time. This is stuff we haven't billed yet. Okay. But the customer has it in their hands, however they got it, for whatever reason. So that's the big picture. And from here, we will be constructing our financial statements. And the financial statements are prepared in the following order. We'll see this in the next video. Our income statement first, stockholders' equity, which all that retained earnings stuff, the revenue and expenses get closed out, dividends get closed out. From that, we can prepare a balance sheet. We'll have a good retained earnings number to work with. And finally, our statement of cash flows, without which we can't survive if we don't know where our cash is coming, where our cash is going. So that's the overview. We're going to do another video. I'm going to do a specific video that's going to address the flow of our year-end adjustments. We'll call it a year-end or a quarter-end or a month-end. I'm going to say year-end just to keep it easy. So I'm going to go through a bunch of transactions and demonstrate those for you in the next video. Thank you for listening.